Welcome to Mutual Fund Family.
Log on to mutualfundfamily.com for more info.
Hello and welcome to this discussion on UTI Mastershare unit scheme. UTI Mastershare has been India's first equity diversified fund. It has been in existence for almost now 32 years, has more than 5 lakh investors. Over the years, the fund has built a very solid reputation for itself. And to know a little bit more about this fund, we are fortunate to have Swati Kulkarni with us today. Welcome, Swati, to this discussion.
Thank you.
Swati has been with the UTI for almost 26 years, and she has been managing the UTI Mastershare scheme for the last 12 years. Swati, what I'd like to begin with you is to just understand your investment philosophy.
Suraj, I'll just take you to the investment philosophy of UTI mutual fund itself to begin with. That investment philosophy runs through the investment processes that we have at UTI. Typically, we focus on companies which have operating cash flows, sustainable operating cash flows, and they deploy capital at a higher return than the cost of capital. UTI Mastershare particularly is a large cap mandate that we have, and our focus is to look for companies which have competitive franchise, and we also look at how much we are willing to pay for these companies given the underlying growth. So we follow growth at reasonable price approach. I think this approach is enabling us to find the long term structural ideas and avoid the tactical plays that could often come in the market. The opportunities such as tactical could be avoided.
Okay. So you mentioned about competitive franchises. So can you just elaborate a little bit and maybe give us a couple of examples to just illustrate this point?
Sure. So when you look at certain companies with competitive franchise, basically we are looking at companies which build these competitive advantage over a long period of time. What essentially it could be like the companies which have tangible advantages like their distribution strength or their after sales services that they provide, or it could be their cost effectiveness or the capital efficiencies that they have delivered for so many years, or it could be intangible sources like strong brand, or it could be the technology superiority or the R&D capabilities that these companies have generated over a period of time, the patents or the regulatory approvals that they have. So essentially all these advantages translate into pricing power, and that ensures that these companies have a sustainable growth, and they keep on investing these growing periods or the strong financials that they enjoy to further strengthen these advantages. All this put together helps them to go through the economic downturn in a much better way than the competition. So staying ahead of competition is what competitive franchise provides the companies which possess that.
As I hear you, I believe that you really are very focused on individual companies, which have distinct advantages in the market. But in today's day and age where markets are so volatile, we know there are so many macro headwinds. So do you think this investment philosophy actually is helpful at these times, or sometimes, it can be like boxing yourself into one idea, and does it remain relevant in these times as well?
So it's a good question. Actually, Mastershare also has an overlay of top-down approach, and for example, where the macro situation has some bearing in terms of what sectors we would like to take active bet on, and then we would look for a bottom-up approach. And when we select that bottom-up approach, I think GARP and the focus on competitive franchise comes out very clearly there. When the example could be like for last 1 year, we had seen that IT as a sector was actually available at a very reasonable valuations because of the concerns on the near term growth. But when you look at the medium term growth, digital spend was a driver. You had very strong balance sheets, so it was fitting in the GARP kind of a hat that I wear for selecting stocks in Mastershare. Now, in addition to that, if you look at the current scenario where oil prices have zoomed, and because we are net importer of oil, that has an impact on our current account deficit and on the currency also. Of course, globally US dollar is getting strength, and hence there is an additional pressure on Indian rupee. In such a scenario, that macro thought is also helping us to stay overweight on IT sector even when the valuations have moved up, and that is providing a tailwind for the margins in the sector. Now, within that, how I apply competitive franchise is that I am looking for companies which have a much better client spread. So, the client concentration risk is not there. That is what will ultimately stand out as far as the IT companies are concerned, because we have seen in companies where client concentration risk is very high, there could be much more volatility if the client decides to move away from you.
So would it be fair to say that since your portfolio strategy encompasses actually the top-down approach as well, and the fact that you're trying to buy solid companies with competitive franchises, especially in downturns like this that we are experiencing in the market, do you believe that you get a little advantage over rest of the market because of the way you invest money in this fund?
Yeah, so Suraj, in last 12 years, I would have seen at least 2 bear phases, and the fund itself has seen most number of bear phases than any other fund in the market today. So when you look at the stock selection process, which is dominated by the competitive franchise thought, as I said, one is that it's a large cap mandate, so you tend to invest in proven business models, and these companies, because they generate high return on capital employed, they are generating economic value for the shareholders. So typical in volatile times or the economic downturns, they are in a much better position to handle this. The management bandwidth is also quite strong. So I think when you look at the past performance of Mastershare, and today we are just talking about 10% correction in market, but I have seen phases of more than 20% drawdowns, and alpha has been generated during this period. I think the large portion of it is coming out of the strategy that we follow at Mastershare, and so it is not only important to select the right stocks, but also it is important to avoid the underperforming stocks.
No, great you mentioned alpha, because I think my next question really is on this SEBI recategorization, and there is a lot of discussion and debate that's going on in the industry whether large cap funds will be able to outperform the marketplace and generate an alpha. And obviously we have moved now to a total return index as well. So in your assessment, do you believe this criticism is fair, that large cap funds will have challenging times to generate alpha, or you see it otherwise?
Of course, I see it otherwise, not because I manage a large cap fund, but if you look at the past history of funds generating alpha over the benchmark over a long period of time, you will realize that there is a fact in what I am saying. I think the investment discipline and the process again comes handy here, because whether it is a large cap or a mid cap, essentially when you look at companies' behavior on the stock market, the investors or the shareholders tend to follow what is in fashion, and that makes these certain stocks quite overvalued. And reverse is also true. Certain stocks which are in a situation which market is ignoring, that tend to become undervalued. Your processes will identify these mispricing. Second thing is when you look at benchmark, these are highly driven by the market cap, and when the stocks are overvalued, their weight in the index tends to rise, and conversely their weight reduces when the stocks are not performing. So I think that again creates an opportunity, and your process will point that out. In addition to that, I think our indices, unless you are following a different style, indices are style agnostic as well as they are agnostic to any corporate governance issues. Whereas when you are looking at active management of funds, you can ignore the stocks which have had some corporate governance issues, and over a long period of time, the companies which have had some blemish on the corporate governance have underperformed. So I think there are enough scope for generating alphas. over a long period of time. But in short term, of course, there could be periods when you may be lagging in the, the benchmark. I would tend to agree from the past data that active fund management has a place in the Indian market still.
Surely, no, I think I'm very encouraged by your confidence and your own ability of actually generating value to the investors who are coming into your fund.
We had done one study where, somebody, and see, when you talk about return, return is ex ante, whereas the choice of funds is ex post. Like people look at the past returns and decide the fund. So we have done a study where, we have looked at if somebody had to invest in from Jan 2006 in only in top performing funds in large and multi-cap category versus someone decides to invest only in Mastershare. You would be surprised that the strategy of chasing returns every year in top performing funds versus investing only in Mastershare has generated alpha over this strategy. So that is something I would suggest that it's a power of the investment philosophy and the approach that the fund follows in terms of the growth at reasonable price and looking for competitive franchise.
So if I were to, take the next question from what you said, that we talked about a peer set, and now with this SEBI reclassification, it's a very clear defined peer set as far as large cap is concerned. So how do you find Mastershare to be different from rest of the peers in the group?
So one is, of course, we have a legacy of, fund being there for last 32 years. So like I said, it has seen the maximum number of bear phases and it has delivered stronger performance during those bear phases on an average. Second thing I would talk about is that, when it comes to the style purity, Mastershare for last 10 years have always maintained, even before these SEBI guidelines came, it has always maintained more than 80% allocation to large cap. So when it comes to our channel partners and our investors, the kind of allocation they have for large cap, there will not be any breach of trust. That is what I think is an important thing. And as I mentioned, it is the uninterrupted dividend track record in a way denotes that the fund, irrespective of bull or bear phases, has continued that, and we have generated alpha also over a long period of time on benchmark. So I think these are some of the positives which stand out in case of Mastershare.
So tell me a little bit more about your own personal investments. So do you invest in the fund or you invest outside? How do you manage your own investments?
Yeah, of course, actually Mastershare, my association started from its inception when my father invested a small amount in Mastershare in 1986. Those days it was a closed-end fund. And of course now, after I became fund manager, I have, it's like a dream come true, because when I saw Mastershare NAV moving 2.5 times in 2 years, in those days, college days, I was fascinated by mutual funds, and probably that would have shaped my career towards mutual fund in a way. Now today Mastershare is a large portion of my equity allocation, and I think that is in line with what we also suggest, that large cap should be the core portfolio of equity mutual funds. And of my SIP also, there is a substantial portion that monthly gets invested in Mastershare.
So before we conclude, any last piece of advice, how to navigate volatility in the current times?
I think I personally feel that when you have your financial plan in place, you will understand that these kind of volatile periods are leading you to distract from your goals. You should be actually thanking the market that it is giving you opportunities to further correct your asset allocation if your equity allocation is not right, because ultimately your long term financial goals are best met by a wealth generating opportunity. So you have an opportunity to correct that, and therefore I think these corrections are your friends. And I would say that when you look at your overall financial planning, if you get into timing the market, what you might essentially do is you are taking much higher risk, because you will only see that market has gone up and you have not invested enough, or you would have taken away the money much earlier. and this may not compensate the kind of risk that you have or the poor allocation to equity as a asset class that you have. So I would suggest that investors should look more from an asset allocation perspective. You can have large cap as a core and have mid cap funds, multi cap funds as a top up. That should be the approach, and of course sector funds we advise that it should be 5 to 10% of your allocation.
Clearly, your experience in managing money, comes out through this part of advice. So, thank you very much for joining us today. I wish you all the success and many more years of success in managing this fund. So, that was Swati Kulkarni with us, discussing a little bit about how she manages Mastershare. What is very heartening to hear is that, there's a very distinct investment philosophy that's built around competitive franchises. She genuinely believes that, this fund is relevant, especially when markets are extremely volatile like the times we are passing through. And as the calmness that she is showing in these volatile times, I think that's what we need to carry, not only when we manage our own money, but also when we meet our investors. So thank you very much once again, Swati.
It was pleasure talking about Mastershare today.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Thanks for watching. Drop a like, leave a comment, and don't forget to subscribe Mutual Fund family.